Hello guys, welcome back to the channel. Before we go any further, just please make sure that you're subscribing to the channel, like the video literally right now. And if you have any questions or anything to add within what we cover in this thing, just make sure you comment. I mean, even a thank you is good as a comment. Just make sure that you are engaging with us. It does help out a lot. So that's basically the little you can do. Next, if you're writing the NBTs, you can basically become a member and then you'll get all the NBT videos that are made. People have really good things to say about the videos that they watch for NBT, like the questions that they come across in the NBT are pretty much very similar to the questions that we covered in our videos. So that's something that you can look forward to. Then thirdly, this video is going to be part of a playlist. So I'm just creating a grade 12 accounting playlist so you can just be able to get all the videos that I will be doing that basically cover these grade 12 past papers. I'm going to be doing a lot more, so just make sure that you can just pretty much check the whole playlist and then you can share, with some of the people that you study with and, you can help each other understand. So that's the whole purpose about the education. So today we are continuing with 2024 November past paper. And we're looking at question three, the interpretation of financial information. We got our answer book here, which won't necessarily be using, but I will be writing my answers in the sheet here. So I got my 3.1 and all of those things. So let's get into it without wasting any more time. So the first question. So let's see. So we have Winston Limited, and it says the information relates to Winston Limited for the year ended 29 February 2024. And then you have the required, and then there's the important note that they put in there. It says where comments and or explanations are required, you should quote financial indicators and trends with figures, give a reason or an explanation for the financial indicators quoted. So this is very key. I think that this way, maybe not this session, but rather this section. That's what I meant to say. But this section, it can be difficult for people because they don't know what exactly to write. And in this session, I'm going to be showing you because I will be writing the answers, and this is something that you can take as a skill and try to apply in all the accounting questions where you have to write and not necessarily do a lot of the calculation. And this is a section that I like in accounting because you can get a lot of marks here. I'm telling you, like that 45 marks, I think you should be getting at least 40 of it, if not all 45. But let's get into the question. So the first question is based on profitability, and we should know what our profitability ratios are. So it says quote two financial indicators with figures and trends to indicate that the company is managing its expenses well. So if you're managing expenses well, it means that there must be something like operating expenses on sales, maybe that's reducing, or you can look at basically your profitability as a business because the more profits that you make or the more profit margin that you're able to generate, then the more that it indicates that you are able to manage the expenses well. So we're going to quote two financial indicators with trends and indicate that. So we're just basically going to quote these two ratios and then make a comment. And that's how we're going to get these marks. So let's look for our profitability ratios in this information here. So let's look at the background information. The CEO, Shakira, was appointed on 1 October 2023. She was awarded a one-year contract on probation. Grant Waters, the majority shareholder, was instrumental in appointing the CEO. And then there's this information about shares, but this is perhaps at the last part where we get most of the information about the profitability. So firstly, we got the markup percentage, but the markup percentage is basically just between sales and cost of sales. It's not telling a story about all the expenses that we are going to look at, but I do feel that the two ratios that will give us a clear direction in terms of these trends, the most powerful one would be the operating expenses on sales. So last year, for every sale we generated, were basically, so if we generated sales of 100 Rand, for example, we would have to spend 19 Rand in operating expenses. In the current year, for every 100 Rand sale that we make, we're essentially spending 14 Rand. So that's the sense of 19% and 14%. So we are spending 14 Rand. So that is a very good thing. So then the first ratio that I'm going to quote is operating expenses on sale. So operating expenses on sale, I'm going to write that operating expenses on sales decreased from 19% to 14%. And then just make a comment. So this indicates that the business, and you can name the name of the business, and you just say the business is managing its expenses more efficiently. That's pretty much all you have to say in there. And then the next ratio that we are going to look at, let's see, it's so we can look at net profit before tax on sales, but I think the one that would be most powerful here would be the operating profit on sales, because obviously we work out operating profit after we subtract operating expenses and subtracting it from the gross operating income. So you can see then that we were retaining 12% in the previous year in operating profit. So 12% of sales would be retained in operating profit. But you can see that in the current year, we have managed to basically increase that by 6%. So then we're going to say operating profit on sale. So you're going to say percentage of operating profit on sales increased from 12% to 14%. And then you make your comment. This indicates the business is managing expenses better and getting a higher margin, a higher operating margin. That's literally all you have to say there. Key thing is that you quoted, and then after quoting, you make your comment. And that's pretty much all you have to do in these questions. And that will earn you all I think it was the 4 marks in this question. Now let's move on to the next question. So what does the next question say? It's on the dividend payout policy. All right. So it says comment on the dividend payout policy of the company. Explain why this is a responsible change in policy, and you need to provide a point. So you're going to have to comment on this. But remember that whenever we want to make a comment, in addition to the comment, we must then also provide a financial indicator that we can quote that proves the comment that we're going to make. So let's have a look then at the issue that is around dividends. Obviously, there is something being said about shares here, but we can go straight into the ratios to see if we can find this information already. Let's have a look. So we're talking about the dividend payout rate. So the dividend payout rate, what essentially it is that, so let's say I make a profit of 100 Rand over a financial year, and then I take 60 Rand and then I pay a dividend. So in essence, my dividend payout is 60 over 100, which is 60%, right? And so if I basically spend most of the money that I make paying dividends, in other words, withdrawing the money from the company, then it can basically limit my ability to raise cash in the future, because I don't have reserves that I keep in I don't have a lot of reserves that I keep in the company. It's always the case that whatever profit that is being made, it is basically being spent paying dividends. So if we look at this case here, in the previous year, there is a payout rate of 86%. So that means that for every 1 Rand that the business made in profits, 86 cents was paid to dividends, which means that 14 cents was being retained for future expansion. But now in this case, the business has basically reduced the payout policy to 60%, meaning that it's retaining 40% for future expansion objectives. So, how do we make a comment here? So, let's just refer back quickly to the question. It says, comment on the dividend payout policy of the company, explain why this is a responsible change in policy, and provide 1 point. Okay, so let's comment on it. The dividend payout policy was 86% in the previous year, and it was reduced to 60% in the current year. See here, we've basically made a comment and we've also quoted the ratio already. And then now the next step is to basically give a reason why this is a responsible thing to do. This is a responsible change in policy because it means that the business will be better able to fund expansion projects from its own profits, right? Because ideally, if you're in a business, you would prefer that your business, with the profits that it makes, it's able to invest. Not every time you want to embark on an expansion project, you have to basically take out from, you have to raise money from shareholders, or you have to take debt, but you can basically be able to use from the profits that the business already made. So this is a responsible change. And then we can just make a final comment that shareholders will be happy because in the future they will benefit even more. And that's pretty much all we needed to say, and that gets you the 3 marks. Now let's move on to question 3.3. This is on earnings and returns. I want to read specifically right from the question paper itself. It says, explain whether the shareholders should be satisfied or not with the earnings per share and returns on average shareholders' equity of the company. Quote 2 financial indicators with figures. Well, in this case, they've kind of made it easy for you because they've actually said exactly the ratios that you should quote, because they said quote 2, but they mentioned them already. So, and we want to then explain whether the shareholders should be satisfied. So let's look at our earnings per share and then also the return on average shareholders' equity. And then from there, we can make a decision if the shareholders should be happy or not. All right, so the earnings per share, if we look at our earnings per share, basically were 104 cents in the previous year, and then in the current year, it is 112 cents. So this is something that the shareholders should be happy about. So we're going to start then with earnings per share. So you're going to say earnings per share. So you're going to say earnings per share increased from 104 cents to 112 cents in the current year. Shareholders should be happy as the business is more profitable. All right, and then we move into the next thing, which is we needed to also comment on the return on shareholders' equity. Now, when we look at the return on shareholders' equity, we also need to look at it in conjunction with the interest on a fixed deposit. So we can see that, okay, cool, our return on shareholders' equity, firstly, it increased from 11% to 20%. And then we can see that the 20% is much higher than the interest that the shareholders would get in an alternative investment, which would be like a fixed deposit, because that's less risky. So basically, what we understand is that it is very risky to invest in equity. So, as it is very risky to invest in equity, there should be a financial reward that is higher than if you had invested in a more safer investment. So, in this case, the shareholders would be happy because you can see that well, they're making 20% and the interest in a fixed deposit is only 7.5%. So, they're basically making about 12.5% extra than they would if they were in a different investment, and also there's an increase. So let's go there then, that return on shareholders equity increased from 11% to 20%, and then we add that shareholders should be happy about the increase and also happy about getting 20% instead of 7.5% in a fixed deposit. All right. Yeah. So basically, that's basically all what will get us those marks. I think that was 4 marks. So basically, quoting the financial indicator and then giving an explanation, that 1 mark, 2 marks, and you do that for 2 ratios, and then you get the 4 marks that are in this question. 3.4 is quite a big one, as you can see that it's a two-part question. There's 4 marks and there's 6 marks. So we need to make sure that we try and nail this one. So let's have a look then. What does it say? It says the financing strategies and gearing. So refer to information C. So we're going to go into C. It says the directors decided to buy new fixed assets in 2024 to enhance the company. Then it says identify two main sources, and these main sources, they say that it must be over 1 million that were used to finance this purchase. So there's many ways a business can finance a purchase, right? One, the business can issue more shares. Two, the business can take a loan. Three, the business can basically use its retained earnings. Four, maybe the business can sell other assets in order to basically finance buying other assets. So those are some of the things that we can look at. But the main key ways that we need to be looking at for the purpose of this question, I would look at the first two that I mentioned. But then if those fail, then we can look at the other ones as well. So let's see if this business did issue shares, and then let's also see if they did take on more loans, and we need to refer to information C in order to get that information. So let's have a look. So fixed assets purchase. So you can see that purchases last year we purchased 4.1 million, but now in this year we purchased 8.1 million worth of fixed assets. And then we have sold just something for 710,000. Then there's a fixed deposit. But then let's look at the capital. So we have an ordinary share capital. You can see that it basically increased from 28.8 million to 31.7 million. And then you can see that the loan as well, 9.4 million to 12.93 million. So in this case, you can see that then this business was basically mainly using issuing shares and also loaning and then taking money from the loans. And then about shares, we can literally check maybe if there's any other extra information that he gave. Said no other shares were issued or repurchased during the financial year, and then on 31 October, each shareholder was offered. Okay, so there was no repurchase mentioned here. So which means that the difference between the beginning and the end of the year is simply the share issue. So what are we going to do then in this case? So as you can see, the answer book makes this a little bit simple because it breaks down the question and you know which part to answer at which time. So the directors decided to buy new fixed assets to enhance, identify two main sources that were used, and you need to provide figures. So the first thing that we're going to say then is that there were new shares issued which generated, so we're going to need to work out this number. So they generated what? So I'm going to work this out here. So you can see if we look at the previous year, we had 28.8 million, now 31,770. So we're going to say 31,770 minus 28 million. Did 28.8 million, so that you can see it gives us 2,970,000. Okay, so I'm going to use that. New shares were issued, which generated 2.9 million for the business, and then you can just kind of show your calculation that this was 31.7 million minus 28.8 million, right? So new shares, so that's the source one, new shares were generated. So the fact that you identified that there were new shares that were issued, that's one mark. And then the second mark comes from providing the number in the calculation. So there we got the 2.9 million. And then the second thing that we're going to quote is that additional loan was taken. So now we've identified another source. The loan amounted to, now we're going to need to work out the loan as well. So let's see, what was the loan? Well, the loan is 12,913,000, but it was 9.4 million at the start of the year. So we're going to go 12,913,000 minus 9,400,000. That gives us 3,513,000. Additional loan was taken. Loan amounted to, loan amounted to 3.5 million, and we calculated that by saying 12.9 million minus 9 point, so minus 9.4 million. So that's how much was generated. It's sorry, I think I wrote that wrong. It's 3.5 million. So those were the sources which were used in order to generate or to generate these funds that would then be used to finance these fixed asset purchases that we see here. All right, so those were the two main sources. And then the next part to this question, it says, explain how the decisions affected the gearing and the risk within the business, called two financial indicators with figures. Now, when it comes to gearing, there's some key things you want to make sure that you're actually looking at. We're looking at the debt equity ratio, and then we're looking at a return on total capital employed, and we're looking at that, comparing it to the interest on the loans. So let's get into that then. So the first thing we want to look at is explain how the decision. So we're going to see, okay, cool, the risk. So we're going to look at the risk first. So let's look at the debt equity ratio. So the debt equity ratio went from 0.5 to 0.21. So you can see now that the business is in much less risk, is in a lesser risk than last year. So what we're going to do there is explain how, okay, so what I'm going to do is I'll quote and explain. So you can still flip it as long as it still makes sense. So I'm going to quote this as this ratio. I think I gave too much space here, but it's cool. Okay, so let's have a look then. So I'm going to start with the asset test rate, debt equity ratio. So debt equity ratio went from 0.5 to 1 to 0.2 is to 1. And then this indicates that the business is in less financial risk compared to previous year. And then the next thing that we're going to quote is the return on total capital employed or average capital employed. So I'm going to use this. Basically, return on capital employed. So they can use average or they can use total capital. Doesn't matter. So you can see here that well, this basically improved, which is a good thing. And if you compare with interest rate and the loans, the business is doing fairly well because it's basically it's getting a loan that it's going to pay 12% on, but on the capital that it raises, it generates 24% return. So that's a good thing. So then we're going to say, well, return on total capital employed, we're going to say increase. So it increased from 15% to 24%. Then we make a comment. Then we're going to say that this is a good result for the business because the business is only paying 12% towards interest on loan while it generates 24%. So this is a positive thing that the business will be happy about. And if you're thinking about the marks, where you're going to get them, so quoting a financial indicator and then quoting the numbers and then giving the explanation, that makes it 3 marks. So identifying debt equity ratio, quoting it, and then also giving an explanation, that's 3. And then again here, finding the ratio, quoting it, and then giving the explanation is then gives you the 3 marks. All right, and then I think we are moving now into our last question here, which is a bit of a long one. Okay, so it's a bit of a long one. So this was 3.4, we're going to 3.5, and then there's a 3.6. Okay, I think I may have missed that. Anyways, I think what I would do, this was not 3 point, so this is not 3.5. So you're going to start 3.5 from here. And then the whole above was just basically 3.4. So, okay, let's move correctly now. All right. So let's go to 3.5 then, just making sure I'm still staying on the thing. So it says Groundwater's percentage shareholding, rights issue, and the shares repurchased. So the first information says that we need to refer to information B, calculate the number of shares that Grant bought due to the rights issue on 31 October 2023. And then after that, we look at his shareholding after the rights issue, and then the total amount that he spent on the shares he acquired through a rights issue, and then no shares were repurchased during the year. Then Grant intends to convince the board of directors to repurchase shares from him in the next financial year, explain why other board members would probably vote against this proposed, provide 2 points. All right, we'll certainly have a look at that. So the first part then is to basically make a calculation for the number of shares that Grant bought during this rights issue. Okay, so let's go and look at the information then. So in terms of the information, let's look how many shares he owned and then what happened after that. So we're referring to information B, key. So it says here, and then information A is relevant because this grant that is being spoken about is a shareholder here, and is a majority shareholder. So 3 million shares already in issue, and it says Grandwater's shareholding. So he is the majority shareholder, and he owned 1,620,000 of shares issued on 1 March 2023. Okay, so our question is not about 1 March, but it's about the rights issue on 31 October 2023. Then it says on 31 October 2023, each shareholder was offered 10 shares for every 50 shares they owned at a reduced price, all shareholders exercised this right. No other shares were issued or repurchased during the financial year. All right, cool. So this makes it quite clear. So it says that 10 shares for every 50 shares that they own. So if this guy basically here at the time that this rights issue occurs, he had 1,620,000 shares. So we need to see, well, how many packages of 50 shares that did he have? Well, to calculate and then take those shares and then you multiply by 10 because he gets 10 for every 50 that he owns. So the calculation then would go like this. We'll say 1,620,000 and then we're going to say divide that by 50, right? So that gives you the number of how many 50 shares that he owns. And then you take that, you then would multiply by 10. And so to get the answer from that, this person basically bought 324,000 shares, right? So that's the first part of 3.5. And then within 3.5, it says calculate grant shareholding after the rights issue. So after the rights issue, well, this is how we're going to look at it. It is that, well, after the rights issue, we have to determine, well, how many shares are issued after the rights issue? And then of those shares that are in issue now, how many of them are actually owned by grant? All right. And so to do this, we know that at the beginning of the year, so we're going to start with total shares. Total shares, we know that at the beginning of the year, total shares. So I'm going to start with beginning of the year. So at the beginning of the year, there were 3 million shares that were in issue, right? And then there was a rights issue. So that rights issue basically said that for every 50 shares, so you're going to say 3 million divided by 50 and then we'll multiply by 10. So that will give us the additional number of shares that were issued, and that additional number of shares that were issued is 600,000. And so the total number of shares that were issued after the rights issue was 3.6 million shares. And then grant shareholding, so look at grant shareholding. So grant shareholding will be, well, at the start he had owned 1,620,000 shares, right? Let me just make sure that that's right. So that's 1,620,000, yes. And then plus the additional shares that he purchased, which was 340, sorry, not 340, but 324,000, right? And then we're going to divide by the total number of shares that are in issue, with is 3,600,000. And then you take that, multiply by 100 to get a percentage. Since I'm doing it on Excel, I'll just get the percentage right here. And you can see that grant's shareholding after that share issue is 54% of the company, which makes him the majority shareholder still. All right. Then the next question says calculate the total amount that Grant spent on the shares he acquired through a rights issue. All right. So basically, how much did he spend on these shares? So we have to figure out, well, how much was basically purchased? How many shares were purchased and what was the issue price? And then from having that issue price of those shares, we'll then multiply by the shares that this guy would have bought, Grant. Okay, so what do we know? We know that 600,000 shares were issued during a rights issue. So we're going to say 600,000 shares issued on the rights issue. and then this will help our calculation because from the previous question, we do know how much was generated from that. Because if you remember well, we had 2.9 million that was generated, but then we need to make sure that we're getting the exact figure. So this was, remember that the shares, so let's see how much was raised. And then therefore you're going to say total capital raised. So the total capital that was raised, if you remember well, it was the 31,770 minus the 28.8 million. So I'm going to do that. So I'm going to work it out now. So I'm going to say 31,770,000 minus 28.8 million. So 28,800,000. So that gives us 2,970,000. So that's how much was raised. So then we can be able to say, well, based on that, the price per share, the price per share would have had to then be the 2,970,000 and then divide by the new shares that were issued, which was 600,000. So 2,970,000 divided by 600,000, which gives us a price per share of 4.95. And therefore, grants, because we're calculating grants expenditure on the shares. So his expenditure on these shares would have then been 4.95 multiplied by the number of the shares that he bought, which would have been 324,000. And so he spent, let me just make these financial so it's easier to read. So he basically spent an additional 1,603,800. All right, cool. Then let's look at what follows after that. So the next question then, now that we've calculated how much he spent, it says, Grant intends to convince the board to repurchase the shares from him at 12 Rand per share. Explain why they should vote against this. Provide 2 points. Well, the first point that I will provide is the fact that Grant recently purchased new shares in a rights issue for 4 Rand 95 and to have is demanding and expecting the company to buy them back for 12 Rand, which is more than double the price he paid for them. Board members are likely to oppose this. So that's one point that I raised. Or are likely to oppose this. That's what I meant to say. Are likely to oppose this. Okay. Now that's one point, but the question said that they want 2 points. So the second point is, and we can even make a third point, but the second point, the other point I'll speak about, but I won't write it. But the other point that we need to look at is basically, well, what is the market price of these shares? So the market price of these shares, well, how much is it? Well, the market value of these shares is 950 cents, right? Which is 9 Rand 50. So how can he expect the company to buy back the shares for more than their market price? And then the other thing that we can also look at is basically the net asset value per share. Net asset value per share is basically the intrinsic value of the shares. And so these shares, if you look at the net asset value is 564 cents. So the company could probably should be buying these for 964 cents, but he's saying the company needs to buy them back for 12 Rand. So that's quite excessive. And then the other ratio that you could go with is the market value, which is 950 cents, which you can also use to oppose. So the one that seems most bizarre is obviously the net asset value per share. So I will quote that. The net asset value of the shares is 5 Rand 64, and 12 Rand is far above the intrinsic value of the shares. And then the third point would be about the market value of the shares being 9 Rand 50, which the 12 Rand is still quite above the price that these shares are trading with in the market. So that would be unreasonable, and it is unlikely that the board of directors will support this. All right, and then we move to question 3.6 and see how we can answer that. So we have two formal questions. This one was a big one, but let's look at this one now. It says the role of the CEO. Explain two characteristics that shareholders would expect of a good CEO. Well, this is kind of more or less a bit general, but you can think about some of the key qualities to be a CEO. And you have to also think that if you're a CEO, you are at the top level of management. So those that do business studies will know that there's different levels of management: top, mid-level, and the base level. Now, if you're at the top level, what is your responsibility? You're basically responsible for the vision, of the strategic vision of the business. So one of the things then that I could say about a CEO, so let's start there, 3.6. A CEO should be someone expected to communicate a clear vision of the company and provide a plan or strategy to be able to achieve that vision. So this person needs to be a good communicator, and they also need to be a good strategist. And then the other thing that you would want from a CEO is that they need to be able, so we're going to say here that they need to be, the CEO needs to be able to consistently generate positive financial results for the shareholders, right? And yeah, so that's another thing. And then perhaps the other thing is a CEO that would be expected of you. You must be able to lead people and be able to attract top talent into the business. You need to have that sort of charisma to be able to draw people into you, and you want to make sure that you are attracting and also retaining top talent that comes into the business. And there's many other points that you can say about someone that is a great CEO, but these are some that I could think of, and I don't want to give too many points. It's just you just need 2 points to basically get those 2 marks. All right, and then it says apart from the factors and financial indicators covered in the previous questions, identify and explain two other points indicating that the company is well managed by the CEO. All right, so we have looked at a few things already, like the earnings per share and stuff like that. So now we wouldn't really focus too much. We need to just look at some of the ratios maybe that haven't been quoted Here, I think one of them easily probably like solvency ratio, and also like liquidity ratios. They haven't been quoted and stuff like that. So we need to basically identify those that are good because they're saying, you need to say something good about the person. All right. So one I would go for then is solvency, the current ratio, as well as the asset test ratio. So you have three very good ratios that the business has improved in. So to read the question again, it says apart from the factors and financial indicators covered in the previous section, identify two other points indicating that the company is well managed by the CEO. So we're going to firstly identify the solvency ratio. So we're going to say now that the solvency ratio, so we're going to say, so you're going to say that the solvency ratio has improved from 2.8 is to 1 to 3.8 is to 1, which indicates that the business can comfortably pay its liabilities. Then the other thing is the current ratio. The current ratio improved from, let's get the actual amount. So the current ratio improved from 1.6 to 2.5 to 1. So 1.6 to 1 to, is it 2.3 or 2.5? 2.5, sorry. So 2.5 to 1. So then in this case, this indicates the business has good working capital management and able to pay its immediate debts as they become due. And then you can also quote even the asset test ratio because that also wasn't spoken about yet, but we just needed basically 2 points for us to answer this question, and we've quoted the ratios that we needed to quote, and that's pretty much it when it comes to the ratios. So hopefully you do understand. If you have any questions, please drop them in the comment section. The answers to this are also available in the description, and then also in the description you will find a playlist where you can basically check how I did question 2 and how I did question 1 of this paper. Until next time, peace.